What if the biggest financial move of the last decade has been happening right in front of us, and almost nobody noticed, while retail investors were watching stocks, crypto, and interest rates? Central banks around the world were quietly doing something very different. They were buying gold. In 2023 alone, central banks added more than 1,000 tons of gold to their reserves, one of the strongest years of official sector buying ever recorded. And this wasn't a one-year event. Central banks have been net buyers of gold for years. So the real question isn't simply, why is gold going up? The bigger question is, why are the institutions that control the world's currencies accumulating an asset that no government can print? Because if you understand that question, you may understand one of the biggest shifts happening inside the global financial system. Gold has already moved dramatically higher in recent years, reaching levels that would have seemed almost impossible just a few years ago. And behind that move is something much bigger than retail investors chasing a rising chart. It is sovereign demand. Central banks don't typically make investment decisions based on social media, height, or short-term momentum. They manage national reserves. They think in decades, not weeks. So when central banks repeatedly increase their gold holdings, investors should pay attention. The central bank gold buying boom. For years, gold was considered an old-fashioned reserve asset, but that attitude has changed. Central banks have increasingly turned into some of the most important buyers in the gold market. In 2022, official sector purchases reached roughly 1,082 tons, one of the strongest annual totals in modern history. Then came 2023 with another extraordinary year of buying, and the buy-in continued afterward. This matters because central banks are fundamentally different from ordinary investors. A retail investor might sell gold because the price drops 10%. A hedge fund might exit because its strategy changes, but a central bank can purchase gold as part of a decades-long reserve strategy. That creates something extremely important for the market: persistent demand. And then came February 2022, the Russia moment, when Russia invaded Ukraine, the United States, European Union, and their allies imposed unprecedented financial sanctions. Hundreds of billions of dollars in Russian central bank reserves held within Western financial infrastructure were frozen. For Western governments, this was a geopolitical response. But for central banks around the world, it created a completely different question. What happens if you're foreign? Reserves become inaccessible because of a geopolitical conflict. That question changed the way many countries viewed reserve assets. Dollar assets had always been considered extremely liquid and reliable, but now governments had witnessed something they couldn't ignore. Financial assets can carry political and counterparty risk. Gold is different. Gold doesn't depend on a foreign bank promising to honor a payment. It doesn't require another government to remain friendly, and it cannot simply be created with a computer keyboard. It doesn't mean countries are abandoning the dollar overnight. But it does mean some governments are increasingly interested in diversification, and gold is one of the few reserve assets that sits completely outside another country's financial system. China's strategy. China is perhaps the most closely watched example. The People's Bank of China has steadily increased its official gold reserves over recent years. At the same time, China has gradually reduced its holdings of US Treasury securities from the levels seen more than a decade ago. That doesn't necessarily mean China is preparing to completely abandon the dollar. The United States and China remain deeply connected through global trade and finance. But the direction is important. China appears to be trying to build a more diversified reserve portfolio, and gold plays an important role in that strategy. China's officially reported gold holdings are still a relatively small percentage of its overall foreign exchange reserves compared with countries such as the United States, Germany, or Italy. That means there is potentially significant room for additional accumulation, and that's exactly what makes China's strategy so important to gold investors. Even a relatively small shift in reserve allocation can represent enormous demand when you're talking about a major economy. India, Poland, and other buyers. China isn't alone. India has also increased its gold reserves and has taken steps to bring some of its physical gold holdings back under domestic control. Poland has been another aggressive buyer. Its central bank has openly discussed increasing gold's role in its reserves. Why? Because for countries dealing with geopolitical uncertainty, gold isn't simply an investment. It's a form of financial independence. And this is where the story becomes much bigger than gold itself. Central banks aren't necessarily saying gold will go to $10,000. They're saying something more subtle. We want part of our national wealth stored in an asset that doesn't depend on someone else's promise. That's a very different message. The dollar is still king, but the share is changing. Now, let's be clear. The US dollar remains the dominant global reserve currency. The dollar isn't disappearing, but its share of global foreign exchange reserves has gradually declined over the past 2 decades. According to IMF data, the dollar share has fallen from around 70% in the early 2000s to roughly the high 50% range in recent years. That's not a collapse. It's a slow structural shift. And the important point is what has been gaining ground. Gold. Gold doesn't replace the dollar overnight. Instead, it provides countries with an alternative reserve asset, one without an issuer, one without a maturity date, and one that isn't directly tied to another country's monetary policy. That makes gold particularly attractive during periods of geopolitical uncertainty and concerns about debt sustainability, the debt problem. And this brings us to another major factor: government debt. The United States has accumulated enormous levels of federal debt, YD interest. Costs have become an increasingly important part of the government's budget. When debt becomes extremely large, governments face difficult choices. They can reduce spending, raise taxes, grow the economy faster, or tolerate higher inflation over time. None of those choices is easy, and investors understand that. Gold has historically performed well when people become concerned about inflation, currency purchasing power, or financial instability. But today's gold rally has an additional component: central bank demand. That's what makes this cycle different: gold's supply problem. Now consider the other side of the equation. Demand isn't the only story. Supply matters too. Gold mining is slow. Finding a deposit doesn't mean gold immediately enters the market. A mining project can take many years to move from discovery to exploration, to permitting, financing, construction, and finally, production. That means today's high gold prices cannot instantly create huge amounts of new supply. Even if miners invest aggressively today, new production can take years to arrive. And that creates an interesting setup on one side. Central banks are buying, investors are increasing exposure, institutional demand is growing. Onde other. Mining supply is growing relatively slowly. That doesn't guarantee prices will rise forever, but it creates a structural environment where demand can put significant pressure on available supply. Why this cycle is different from 2011. Remember 2011? Gold reached almost $1,900 per ounce before entering a major correction. Wow. What? Because a significant portion of the demand was driven by investment sentiment. When sentiment changed, money moved out, gold fell dramatically. Today's market has an important difference. Central banks are now a much more significant part of the demand equation. They aren't buying because gold moved up yesterday. They're buying because gold serves a strategic purpose inside their reserves. That doesn't make gold immune to crashes. It doesn't mean the price can't fall 10%, 20%, or even more. It means the market has developed a potentially stronger structural demand floor than it had during some previous cycles. But there is a warning. And this is where investors need to be careful. A powerful long-term story does not mean gold only goes up. Gold can experience brutal corrections. Interest rates matter. The dollar matters. Inflation matters. Recession matters. And investor sentiment still matters. If the global economy suddenly enters a powerful deflationary environment, or if real interest rates rise sharply, gold could face significant selling pressure. That's why nobody should look at a $5,000 plus gold price and assume the next move has to be higher. Markets don't work that way. Even the strongest bull markets experience corrections. The real question is whether those corrections represent the end of the trend, or simply temporary pauses inside a much larger structural cycle. What do the big banks expect? Major financial institutions have continued publishing relatively bullish long-term gold forecasts. Some analysts have placed potential targets well above current levels, with scenarios reaching towards $6,000, $7,000, or even higher depending on central bank demand, inflation, interest rates, and geopolitical risk. But forecasts are not guarantees. A bank can be wrong, an analyst can be wrong, and markets can behave differently from every model. The more important signal isn't any individual price target. It's the behavior of central banks themselves, because central banks don't need to predict the exact gold price 5 years from now. They only need to decide whether gold deserves a larger place in their reserves. And increasingly, the answer appears to be yes, the bigger picture. For decades, investors were taught that gold was primarily a hedge against inflation, but something broader may now be happening. Gold is increasingly becoming a hedge against systemic and geopolitical risk. It's a hedge against currency concentration, a hedge against sanctions, a hedge against excessive debt, and, perhaps most importantly, a hedge against dependence on another country's financial system. That's why this story isn't really about whether gold reaches $6,000 or $7,000. The bigger story is the changing architecture of global reserves. For decades, the world operated around a dollar-dominated financial system. That system isn't disappearing tomorrow, but countries are gradually adding alternatives, and gold is one of the clearest beneficiaries. So the next time you see gold hitting another record high, don't just ask, how much higher can gold go? Ask a different question. Who is buying? Because if the biggest buyers are governments and central banks building decade-long reserve positions, you're not simply watching a commodity rally. You're watching institutions quietly reposition their balance sheets. And that may be one of the most important financial stories of this decade. The people who control money are accumulating the one monetary asset that cannot be printed. And whether you believe gold is headed higher or due for a correction, one thing is becoming increasingly difficult to ignore. The global monetary system is changing, and gold is sitting right in the middle of that change. If you want more deep dives into the forces actually moving global markets,